What does this mean for Kevin Warsh? Does it take off the pressure that the conventional wisdom is implying today?
Yeah, well, good afternoon, and thank you for having me here. Yes, absolutely. If you take this report at face value, then absolutely this takes that September and very likely even in October, December rate hike off the table. But as a previous guest mentioned, you kind of have to look at this report and say, well, there's some potential here that you got some variables moving in one direction. You got unemployment rate dropping, but it's dropping for the wrong reasons. There's a lot of variance in this report. So for now, if you just look at this for what it is, you'd say, okay, we got wage growth of 3.2%. That is certainly not inflationary. You have essentially job losses. That would be consistent with the Fed on hold in September, at the very least on hold in September.
Mm-hmm. Well, if the Fed does hold in September because you aren't seeing the pressures on the labor side of the equation that would look to them to be concerning if they were to tighten policy, but you still see sticky inflation, if that's what we end up seeing in the CPI report, could that just continue to fuel the narrative, Tom, that the Fed under Kevin Warsh may be willing to let inflation get away?
Well, for those who want to sell that narrative, that will definitely fuel it. But for those who look at this and say, okay, well, why do we have somewhat stickier inflation? Well, we have goods inflation. And over time, I hate to use this phrase, but goods inflation over long enough periods of time does tend to be transitory. It does tend to average about zero. I'm still worried about the service sector inflation. So I would look at this report and I'd say, okay, we have a somewhat of a supply shock. It is predominantly driven not by tariffs, but by energy prices. And you don't tighten into a supply shock. That's a policy mistake. We've learned that time and time again. So if you're Kevin Warsh, you look at this and say, okay, I have goods inflation driven by energy prices rising. That is not something that I'm going to tighten into at this point, especially with a labor market that looks like on the surface it's softening.
Yeah. Mm-hmm. What's the bond market telling us more broadly here, Tom? We're down a couple ticks, but it was just a week ago, the 30-year crossed 5.2% and heads exploded in the market. Remember that day the Dow was down over 1,000 points? That was the Fed day. That's when there was great concern about Kevin Warsh's posture. We're still above 5.2% here, and the stock market is cruising along like it's not happening. What is this telling us about future prospects for our economy?
Well, what it's telling us is that we have a Fed chair who is finally willing to put the power of the purse back in the hands of the bond market. For the last decade and a half, we've had essentially a bond market that has been put into, for lack of a better term, a medically induced coma, where there's been no real ability to push back on fiscally imprudent policy. Now Kevin Warsh is, and he's the first Fed chair we've had really since Greenspan, who is willing to say, listen, the Fed's balance sheet is too large. It has resulted in a blank check to government, and that has to stop. So the bond market is saying Kevin Warsh, if he gets his way, is going to, at some point in time, begin to shrink the balance sheet, either in absolute terms or at least relative to GDP. And what that means is
vigilantes are unleashed.
Yeah, vigilantes are unleashed, and that's bad for both political parties, especially in 2029 and beyond. But as of right now, the bond market's got to look at this and say, okay, well, we've got to start building some risk premium into longer duration treasuries because the balance sheet is not going to be a source of stabilization for long-term interest rates. That's really what is being said. That's what the market's saying. But there's this narrative that he's losing control of the bond market. Well, the Fed should have never had control of the bond market in the first place. The bond vigilantes, the way I like to think about it is the bond market has always been the final check on bad government, whether it was be by dictatorship or democracy. Let's put it back in the hands of the bond market and not in the hands of policymakers in D.C.
Well, so does the market actually force lawmakers to get the fiscal house in order? Because I hear what you're saying on the balance sheet, but there's no sign that the Treasury is going to be pulling back on issuance anytime soon. We're still going to have to borrow to finance pretty much everything.
Well, I mean, this is a slow process. It's not going to be all of a sudden that the checkbook gets ripped up. If you were to look at this and say, what could Warsh achieve? It may take 3 to 5 years before the balance sheet, even in nominal terms, I should say relative to nominal GDP, has shrunken enough so that the bond vigilantes can really push back. So it's not going to be an immediate phenomenon. But what you're seeing is it's a gradual creep higher. And where are you seeing it happen? Well, it's been happening in the 20s and 30s. 10s are still below their cycle highs, but 20s and 30s are inching higher and higher because there's less demand in those portions of the curve. 20s in particular, it's just a weak portion of the curve. So that's where you're going to see it the most.
Will the consumer price report next week codify this trend that we're talking about?
So here's the interesting thing. I think today's jobs report is a temporary reprieve from the September rate hike outlook. I think that inflation report next week is going to say the opposite, and that is that you're seeing inflation gradually trickling higher because of the second or third wave of we'll call it, of energy price escalation here. So that CPI report next week should be stronger or higher than expected, and that should bring the September rate hike right back onto the table.